Great. Thanks. Appreciate it. I'll let everybody read sort of the disclaimers on their own time. This is the same presentation that's on our website. So all this information and more. We've got videos and other kinds of media. So a lot of info to sort of troll through if you feel inclined. The quick background on Trident, for those that aren't familiar with us, we listed just over 2 years ago on the AIM market of the London Stock Exchange. When we listed, we sort of had a strategy, which I'll go through in a minute, but a strategy, and we secured one cash flowing royalty, and we did a raise at 20p, raised a bit of capital to go out there and deploy it into the market. You fast forward 2 years to today, and we've got north of 20 assets, a dozen of which are cash flowing, and our share price has taken a bit of a hit recently, like many, but we're still hovering around sort of 40p a share. So have been moving in the right direction. And importantly, liquidity and everything else has advanced in a positive direction since we've listed. So taking a step back, so recognize not everybody's familiar with royalties as instruments. I'll give you sort of the quick sort of 2-minute overview of them. So royalties, many people are probably familiar with music royalties and author royalties and movie royalties. Mining royalties are not hugely dissimilar in the sense that it entitles the royalty holder, Trident in this case, to a cut of the revenue of an underlying asset. So in the case of a movie, every time it's shown or played or syndicated, the creators of that content get paid. We're similar. We've got royalties over specific mining projects, and when they generate revenue, we get a fixed certain percentage of that underlying revenue. So there's a few nuances to why that's a good way to get your exposure to the mining sector. You can see on this table, we're comparing ourselves to the choices investors have effectively. You can pick mining companies to invest in that actually operate the mines, or you can go out there and sort of buy physically backed ETFs or other sort of instruments that are sort of give you strict exposure to just the metal prices. Now, the way that royalties are different is, and it's underscored in an environment like we're in today, where what you see is this sort of hyperinflation, right? And that drives up the price of real assets, in our case, commodities. So as copper, iron ore, gold, these other commodities, as their prices are being pushed up, we would see that realization in that it drives, all things being equal, it increases the revenue line item of the operators. That they're producing 100,000 ounces of gold a year, and the gold price is pushed up with inflation, then they're going to realize more revenue, all things being equal. But what also happens is the miners, they've got a significant cost to actually mine that material. So they're seeing their inputs also increase with inflation. So, a mine site there, 10 to 15% of a typical mine site cost is diesel fuel, for example, and labor is an even more significant chunk of cost for them. And so those costs are also increasing. So what you tend to see is mining equities have a quarter or two of sort of outsized performance, and then they sort of regress to their natural profit margins. But a royalty company doesn't have that issue because we're getting the upswing in the increase in revenue associated with increasing metals prices. But we don't have the same sort of cost structure. We're not exposed to the cost lines of the P&L, their operating costs or their capital costs. So we're this sort of natural inflation hedge where you get exposure to real assets, but not exposure to any associated inflation that sort of pulls down the return there. Now, physical commodities would sort of have a similar dynamic. I guess the reason people invest in mining equities is because mining assets tend to outperform. And what I mean by that is I think it's over 80% of mining assets that come into production end up extending their mine life, or they'll expand their production profile. And that's why people invest in mining equities rather than just the metals directly. It's because you want to get some of that outperformance of the individual assets. So in that sense, mining royalties give you sort of the best of both worlds. You're exposed almost this derivative style exposure to commodity prices and not underlying costs. But then you're also getting the asset level exposure because our royalties are over specific assets. So as they extend their life, we get that benefit as well. So it balances the two very nicely. And then on top of that, mining royalties tend to sit senior in the security waterfall. In fact, we've got one royalty that's a senior secured position, so it's got security over the entire property. But they tend to sit sort of either pari passu or just below mezz debt. And then in the cash flow waterfall, you get paid first. Effectively, they generate revenue, and we're an operating cost from the miner's perspective. So a lot of benefits to royalty companies. on top of the fact that it's obviously a very leverageable type of platform. Lenders love to lend to mining royalty companies because we can take that capital, redeploy it from the lender's perspective relative to lending to a junior that's sort of the same market cap as Trident. That junior would have maybe one project, maybe two, and they're exposed to single wall failure at their operation, and suddenly the lender's in recovery mode. We don't have that issue because we're a junior, but we've got 20 odd assets, a dozen of which are cash flowing. So from a lender's perspective, it's a dream to be able to lend to a platform like Trident, and it allows us as we get larger and more diversified to increase the amount of debt that we use to make acquisitions and lessen our reliance on the equity markets. The other sort of scalable aspect of royalty companies is the fact that we've got 4 full-time members of the management team. I often reference Royal Gold because they're here in Denver, where I'm based. They're a circa 7 to 8 billion market cap company on any given day, and they've got 26 employees, I think. Franco-Nevada sort of bounces between 25 and 30 billion market cap. They've got sort of, I think, 38 employees, so very scalable in many respects. And you can see that sort of played out here, and relative to these are the 3 big gold royalty companies relative to the gold miners index, and all 3 have obviously outperformed mining equities. I'd encourage you to look at all royalty companies. It's almost uniform, outperform mining equities. You'll notice here that we're using gold companies, and that's really leads into the strategy that Trident has, because I mentioned there's some large royalty companies out there. In fact, the sector as a whole is almost 80 billion collective aggregate market cap. So it's a big sector, and it's a meaningful piece of the mining finance landscape. So the question we often get is what is Trident doing different? And this chart really sums it up nicely in the sense that you can see the breakdown of the global mining sector by commodity bucket. So it's roughly a third precious metals, gold, silver, a third base metals, so your copper, nickel, zinc, and then a third bulks, and increasingly battery metals and industrials. Bulks being sort of iron ore, for example, and battery metals being lithium, cobalt. So you've got this large industry that's sort of a third precious, a third bulks, and a third battery and bulks. And yet when you look at the mining royalty sector, that sort of bottom left donut chart, you've got the big 3 gold-focused royalty companies at 81% of an aggregate 80 billion market cap sector. And then you've got 12% that's other gold-focused royalty companies. There's about 20 odd. And then there's 7% that's non-precious. And actually of that 7%, 70% are single asset, sort of iron ore, seemingly passive vehicles where they've got a big iron ore royalty and they pass that sort of cash flow through in the form of a dividend. So actually of that 7%, you really got a subset of 30% of that that's focused on what is almost 2/3 or is over 2/3 of the mining sector. So you've got 7% that's focused on base metals, bulks, and battery minerals. And then you've got sort of 93% of the mining royalty sector that's focused on that 1/3 being precious metals. And that was the clear dislocation. In fact, when we set up Trident, that was the genesis from my personal perspective was, and the reason we sort of took the risk of effectively starting a startup was you just don't come across those sort of dislocations in an industry very often, because there are literally thousands of existing royalties out there. Many of them are precious metals, but many thousands also in non-precious metals. And then in a market like we're in today, the sector's hungry for capital and equity markets aren't there. So royalty financing, to be able to place royalties on good assets that will be coming into development to feed this EV revolution, for example, ample opportunity in that sector. So that's really the strategy in a nutshell. Is we're opportunistic when it comes to gold royalties. We'll try to snag and win them where we can. What we won't do is compete with the 20-odd Canadian-listed gold royalty companies that focus exclusively on that sector. We'll pick them up opportunistically when they meet our return hurdles. And then the real opportunity we see is sort of in base and battery metals. You can see here a snapshot of Trident's sort of growth over the last couple of years. Obviously, it's nice to show a share price chart that moves up and to the right, but really the focus here is the fact that when we listed, I would articulate that strategy that I just described to you, and I think many people would sort of listen to that and say it sounds compelling, but we had one small cash flowing iron ore royalty, so they wanted to go out there and sort of prove your thesis, and I think we are now through that proof of concept phase. When you look at the deal velocity, that's probably the key thing on this slide is we've gone out there and done 11 transactions for a total of over 20 assets in our portfolio over the last 2 years. And while we've done that, we've also seen liquidity increase significantly. In fact, our liquidity for calendar year 2022 is materially higher than it was last year, such that investors can put their money in, they can get it out. It's a liquid stock on AIM, and it's getting more so sort of every week as we grow. Pivoting now to a bit on the actual portfolio. I won't drag you sort of through all the 20 odd assets, but I will sort of flag a couple of them in particular because I think they give shareholders and potential investors a bit of a flavor of how we're sourcing these deals, how we're pricing them, what we look for with regards to return hurdles. So the portfolio, you can see sort of a map there. A couple of things probably jump out to you. One is there's pretty broad geographic diversification, and that's quite intentional. We've flagged here 62% of our NAV is in Canada, US, and Australia. I think that's what our investors want. They don't want us to be a purely emerging markets style of exposure. So we want good tier one mining jurisdictions that are suitable for royalties. Importantly, most common law countries accommodate royalties such that they sit over the actual property. They're on that ground. They're there in perpetuity. They never go away. They survive bankruptcy of the operator. So those sort of characteristics are obviously important from a geographic perspective, as is obviously political risk and these other sorts of things. So, focus on tier one jurisdictions, and we'll venture further abroad on the basis that we price in that risk into our return profile. If we're going to a more risky jurisdiction, we need a higher return. And then also we do need to have that comfort that the royalties are in jurisdictions where there's survivability of the royalty and they run with the land. The other thing worth flagging on this slide, I think it's often a misconception that because we're a junior royalty company, people assume that our royalties then are on junior-led assets, and ergo are higher risk assets. They're marginal operations that are more likely to shut down in a market downturn. It's actually almost the exact opposite. When you look at the list of our operators here, and this isn't an exclusive or an exhaustive list, but you can go through each one, and all of our key assets are with good mid-tiers and in some cases major operators. The likes of Ganfeng Lithium is a 40 billion market cap company, and Lithium Americas is sort of circa 3 billion Canadian. So good, big operators, good access to capital, strong balance sheets. That's obviously a key consideration when we're making acquisitions. To be sure, the royalties are right-sized for our portfolio. Otherwise, we'd be a multi-billion market cap company as well. But really the point here is that we don't, being a junior, we're not sort of exclusively relegated to getting royalties over junior projects. They are good quality projects. You can see here a bit of a snapshot of our portfolio. This is the broker sort of numbers in terms of revenue and breakdown of our portfolio by commodity and by stage. You can see we've actually got a mix of all those sort of key buckets: base metals, battery metals, bulks, and precious metal. And then you can see sort of our revenue growth profile. And I'll talk to some of the specific assets in a moment, but what you can see is the growth has been exponential. We generated just over $1.5 million in revenue last year. This year, the broker sort of numbers around 15 million. We'll be putting out our Q2 update here in the next couple of weeks. And I think we're tracking well in that regard with regards to revenue expectations for this year. So we're growing exponentially from a revenue perspective. One of the challenges that royalty companies have is that you have a large number of underlying assets. So whereas with a mining company, you can tend to sort of take their key assets, build a financial model on those assets, and then drive a value. Royalty companies tend to be valued on their cash flow metrics. So, they take revenue and they slap you with a 10 to 12 times revenue multiple, and that's how you trade. And in fact, that's effectively how we're trading at the moment. But what that doesn't take into account is the growth profile. The fact that the bulk of our NAV, our net asset value, is actually in development stage assets. To be fair, assets that have a very clear line of sight to first production, very clear line of sight to cash flow from our perspective. And yet that's by and large not priced in today. People are sort of taking our projected revenue and hitting it with a multiple, and that's how we trade. So it completely discounts this growth. And obviously, as management, that's a key prerogative for us is to try to bring forward that value realization. And you can really see it here. I won't sort of delve into the numbers too much given the time, but you can see we've had a nice share. This is through end of June. We've had a nice share price performance this year, best performing royalty company in that regard. And that was largely driven by the fact that we've seen the step up in revenue that we've delivered. So I think that's been realized, but we are being valued on cash flow effectively, and you can see that then in our price to net asset value multiple PNAV. Now we're trading at a discount to our net asset value because so much of our value is in advanced or development stage assets that are not getting much attributable value today. We're being valued on what's in cash flow today, and what is on track for 2 years from now is heavily discounted if it's considered at all. And so that's the dislocation. Frankly, that's the opportunity for shareholders, because when that cash flow is realized, we're going to see a re-rate in the share price. I think with confidence we can say that. Really, our job is to bring forward that value realization earlier, so we don't have to wait for these assets to be in production before the value is realized. I mentioned I'd take you through just a couple of our assets. As I said, I won't sort of delve into the technical aspects of them, but rather how we sourced them, how we priced them, what sort of returns we were looking for, what's happened subsequently to acquiring the royalties. All these are sort of key things, and I think provide a bit of color in terms of how we're approaching deals in general. So Thacker Pass is our largest asset on a NAV basis. It's not in production today. Many of you may be familiar with it because it is a large, globally significant asset. Largest lithium reserve in the U.S., most advanced lithium project in the U.S. by a long shot. Actually, one of the largest lithium resources globally. It is a tier 1 asset in a tier 1 jurisdiction. So this was an existing royalty. It was written over 10 years ago now. Was written by a closed-in fund. A couple nuances around that. One was lithium was not sort of the critical battery mineral that it is today. That realization wasn't quite there yet when this was written back in 2011. And then obviously Thacker Pass was much earlier stage as a project. It was an exploration project at that stage. So you fast forward today, obviously the optimal time for that closed-in fund to sell the royalty would be when the asset's in production. You'll get the best value at that point in time. But being a closed-in fund, they had a fixed date by which they needed to sell their assets, that they couldn't sort of wait beyond that sort of timeline. So there was an imperative to sell from their perspective. So I suppose the key thing for us then, because we knew of this royalty, we knew of its existence, and it's a big royalty over a big asset. The critical piece for us and for all mining projects is you need to have clarity on permitting and clarity on financing of construction. And we saw that sort of clarity materialize in January of last year. Effectively, the operator, Lithium Americas, received a record of decision on the federal permit and the assets in Nevada, so there was never too much risk around state permits. And in fact, they've all been finalized subsequently to our acquisition. But they got record of decision on the federal permit, and then they went out and raised $400 million towards construction of this project. So where the project stands today is Lithium Americas is sitting on nearly $500 million in cash now, plus undrawn debt facilities. So ample capacity to commence construction, which they flag is intended for second half of this year. But the permitting process in the U.S., there's one final opportunity to challenge the permit, as it's been described to us by legal counsels, and we're familiar with the process in general, is you can know once the permits, there's been a record of decision on the permit, it's effectively been issued, but you can challenge it one final time on the basis of the permitting process, in the sense that there was some fatal flaw in the permitting process or some gross negligence. It's a very high bar, as you'd imagine, at this stage. In fact, it's the Bureau of Land Management that issued the permit that's being challenged. So that's expected to be finalized in this quarter. And then from there, the project should be moving into construction back half of this year. In terms of how we were pricing the deal, we modeled a 16% post-tax IRR. It's important to flag that's a 16% return year after year for a 46-year reserve life, and the resource is 4 times the size of the reserve. So ample capacity for that mine life to extend or for the production profile to expand. And indeed, after we bought the royalty, the operator announced a plan to expand the plant production profile by a third. So that bumped our base case 16% IRR up to a circa 20% IRR. And this was all predicated on $12,000 per ton lithium. As we stand today, lithium's spot price is about $68,000 a ton. So that waterfall chart you see at the bottom is the expected cash flow at full ramp up of the asset, cash flow attributable to Trident. And with the planned expansion production profile, obviously there's a step up in expected revenue. And then pick your lithium price. We used 55,000 anecdotally on this slide. As I said, it's sort of hovering around 68,000 today. But at 55,000, it would be paying us about over 45 million a year in revenue. And again, that's for a decades-long mine life. So substantial cash flow. So when going back to valuation, when I flagged that we're trading on our effectively our sort of revenue expected this year, and it gets sort of a very healthy discount, if any value realization at all, for an asset like Thacker Pass. That's really the imperative for us, is to try to bring forward that value realization to the market. It's an outstanding asset. It's expected to move into construction this year. So very clear line of sight of when this all sort of comes to fruition. And as I said, the big catalyst for us is finalization of the permit, which is expected this quarter based on the operator's guidance. So will be a big catalyst for us. And off the back of that, then they'll move sort of straight into construction. The only other asset I'll sort of drag you through in terms of description is the Rebecca Gold project. I do this one just because, as I mentioned, the gold space is more competitive than the non-precious focus space. But yet we do find attractive assets in the gold arena. What we tend to not do is compete head on with our Canadian peers that are purely gold focused. This asset was located in Australia. We bought it off the geologist that pegged this ground many years ago. Bought it for just over $5.5 million US. And subsequent to our acquiring the asset, it's done all the things you want a royalty to do. You've seen the resource expand significantly. The confidence of the ounces in the ground have expanded materially. And then probably most importantly, the asset was acquired by Ramelius Resources late last year. Ramelius is a good, large Aussie mid-tier producer. They effectively have a pretty thin pipeline of projects. They've got 2 operating hubs, and Rebecca's sort of clearly their next project on deck. And in fact, what you've seen is there's been a significant increase in the drill program. The resource that's been delineated today, which is over 1 million ounces, but it was delineated on 110,000 meters of collective drilling. This year alone, Ramelius is doing 75,000 meters of drilling and planning a new updated resource. When they made the acquisition, they flagged that they want this to be a 10-year mine life at least 100,000 ounces per year. So, at rough sort of spot gold prices move around a bit, but that would be somewhere between 2.75 and 3 million a year in revenue to Trident for an acquisition we made for $5.5 million. They're still flagging sort of late 24, potentially early 25 in terms of when this asset comes into production. A lot of that will be guided by the success of this drill program. Without a doubt, it'll be an asset that's in production. It's already of a size and scale that supports a mine. So really, it's a question of timing and how large it will be. But again, it comes back to you can find value in gold royalties. This is again, mid-teens to upper teens post-tax IRR on a good quality free milling open pit gold in Western Australia in one of the most prolific gold mining regions in the world. So a very high quality asset, and we've got a royalty over the entire asset. It's uncapped, covers all the ground. So a very attractive asset. And as a bit of validation, we've actually had many of our peers that are focused on gold royalties reaching out, sort of inquiring about this asset because it is such a very clear value proposition. In terms of upcoming catalysts and recent catalysts, I won't sort of read you through this entire list, but I touched on a couple of them just via the Thacker Pass and the Rebecca Gold project. Thacker Pass, clearly we've seen events like the increase in the resource, the increased production profile, and then yet to come is finalization of the permit. This quarter, expected commencement of construction this year. They flagged, they'll be releasing the final feasibility study and likely announcing their strategic partner. A lot of speculation on who that's going to be, whether it's a Tesla or an off-taker of the lithium. But regardless, a lot of news flow to come out of the existing portfolio. And similar with Rebecca, they've increased the resource since we've acquired it. They've been acquired, and then more resource upgrades to come, and probably clarity on timing of cash flow from that asset to come as well. And we've got a whole portfolio of 20 odd assets that are generating this organic news flow. So it's a dynamic business model, I guess, in that regard. Whereas in the early days, the bulk of our news was new deals. We'd go out there and announce a new deal, and that was sort of the exciting news. Now, obviously, we're always working on new deals, but you've also got this sort of generation of news from a portfolio of assets that are moving in the right direction. So quite a number of exciting things we see sort of on the horizon here. The final thing I'll touch on before pivoting to questions is capital structure. You can see we've actually just in the past couple of months have been picked up by a couple analysts. We were always covered by Tamasis, which has a 70p price target on us, but we're recently then picked up in coverage by Liberum and Stifel, both with good target prices on the stock. And probably most importantly is our register, when we initially launched, as you'd imagine, with one royalty and a very interesting sounding strategy, the support came out of mining-focused funds and resources-focused funds more generally. As you'd expect, they know the space. They could see the opportunity with a bit more clarity than generalist investors. But now what we're getting to is a point at which you're getting good UK institutional money. It's not always sort of specific to mining, but the likes of Amati, UK fund coming on the register, BlackRock in the last raise. So and a number that are sort of just under the sort of 3% reporting threshold. Good UK institutional money, sticky capital, getting a toehold position, like what we're doing, how we're allocating capital and managing our share register, and want to get involved as we continue to grow the business. The final thing I'll flag is a key consideration for investors, obviously, how management is incentivized. And for us, it's equity. We're pretty open that we're incentivized with options package. The bulk of there's different various pricing structures on different option award, but the bulk of our option awards are a structure where it has a strike price of 50p, so they're in the money north of 50p. But the vesting conditions are 80p to £1.20 in equal tranches, and so we've got to get the price to those levels, hold it there for a year at each level, and then that tranche vests. And when it vests, it's straight into the money, but I'd argue that shareholders will be pretty pleased if we're getting the price up to 80p to £1.20, and then we see value in our options, and clearly shareholders who are sitting at sort of 39, 40p today are seeing value in their shareholding as well. So that's a critical consideration. I think quite a differentiator relative to other companies that sort of issue free equity or nil cost options. So I think those were sort of the key messages I wanted to cover, and I see a couple of questions have come in, and I suspect a few more will continue to come in. So happy to sort of shift to the Q&A portion.
Great, Adam. Thank you very much. And yeah, you're quite correct that the questions are coming through. Some of them are marked as private. So yeah, I think well, maybe you do see the private ones. I don't know. But so there was a question that came through quite early on about the dividend schedule. What are Trident's ambitions to start paying dividends?
Yeah, I'll just jump back to our revenue chart there, because I think our intent is to articulate a dividend policy in the nearer term, so people have absolute clarity on what our objective is here. Clearly, the UK is a very yield-focused market, so I think initiating a dividend, as somebody incentivized by equity, that's going to be an exciting day for all of us. Clearly, when you look at sort of this revenue profile, it's in sort of 24, 25, you could see a sustainable dividend coming on. I suppose the key thing I would stress is this is the revenue profile we've built in the last 2 years of being listed. And the intent is to continue to build that revenue profile and pull forward the date at which we can commence a dividend. Because I do firmly believe that it's a company's job to build up revenue and then pass that revenue on to shareholders in the most tax efficient manner as we can. So that's the ultimate objective of the company. But at the moment, our target portfolio return profile is a blended 15% post-tax IRR, and we're finding deals at that kind of return profile. So most of our investors, while they want to see a dividend on the horizon, at the moment want us to continue to recycle capital into the business and continue to build out the revenue profile.
And when you say most of the investors, what's the attitude, for example, of some of the institutional ones you'll bring on? I know, for example, you probably know this yourself, but I mean, BlackRock World Mining, one of the most popular UK funds for many reasons this year. So, what's the sort of thing you hear from the institutional investors in terms of whether they want to see dividends paid out?
Yeah, I think most share, and we touch base with them frequently, as you can imagine, because we ultimately work for the shareholders. But most of them sort of share that view. They know it'll be a good day for the share price when we can initiate an inaugural dividend, but want to build up a profile, a revenue profile that supports a good, sustainable, diversified dividend, such that you've got longevity in the dividend. The worst thing you could do is sort of have a bit of a start-stop where you commence a dividend and then you need to pull it back for some reason. So I think as long as there's opportunities for us to deploy capital at the return hurdles we're finding, we're going to continue to do that. As I said, this is the revenue profile we built in the first 2 years. Continue to build it such that the dividend can be as large as possible. And with regards to actual sort of guidance on how we think about it, yeah, I'd sort of point to most of our gold-focused royalty peers. They tend to pay out circa 20 to 30% of free cash flow in the form of a dividend. So you'd naturally probably err towards the more conservative side of that initially, and then at sort of a progressive dividend over time. But that's the sort of piece of work we're doing, and would hope to be able to deliver that clarity sort of over the next 12 months. So there's a specific dividend policy in place waiting to be implemented.
Mm-hmm. Great. And could we actually just to go back to the forecast revenue, because there was a second question about that. I mean, I think the rule of thumb with these events, as soon as people see an upward right line, like you mentioned earlier, eyes kind of open rather widely with enthusiasm, not disbelief. So yeah, the question was asking here, what's the breakdown of royalties that have already secured? This very impressive chart that we're all looking at now, how much of it depends on future acquisitions?
Yeah, that's a good point. So this is based on our portfolio as it stands today, and shareholders would be aware we've also got a right to acquire 50% of a royalty over the Sonora lithium project, and that's excluded from these numbers here until we actually acquire the royalty. We've got this long-dated right to acquire it, but until we actually acquire it, we don't want to start baking in projected revenue. Although that's an asset that's sort of in early works of construction, as we understand, and plans to commence construction in earnest next year. So moving towards cash flow again, but we've got a long period of time at which to exercise that right to purchase. So we won't bake that one into our revenue quite yet. So to answer the question, that's our existing revenue profile. Assets like Thacker Pass, you can see sort of in the battery metals turning on. We're projecting 2025. I think the company's still guiding towards late 24, but we'd expect 25 is when you start to see some more material revenue, and then it kind of ramps up from there. But yeah, then really the objective in my day job is to find acquisitions that continue to build that revenue profile.
Mm-hmm. And a question that's just come through about whether you're looking at lithium, when it comes to acquisitions, are you looking for more lithium in particular?
I wouldn't say lithium in particular. In fact, there's probably a slightly higher bar on lithium now at the moment for us, given we've got the royalty over Thacker Pass and the right to acquire the royalty over the Sonora lithium project. So you've got two tier one globally significant assets rumbling towards first production in the next sort of few years. So we've got quite a bit of lithium exposure is what it boils down to. That we wouldn't completely turn away an attractive opportunity, but I think it's a slightly higher bar. Our prerogatives at the moment are base and battery metals, so we'd love to get more copper in the portfolio. We'd like to get zinc, nickel, some of the sort of secondary but critical metals that sort of often get overlooked, like tin and others. We'd like to get some of those in the portfolio, because ultimately what we want to get to is a diversified portfolio such that a shareholder can buy some shares in Trident and say, I've got exposure to the entirety of the mining sector. I've got nickel, copper, zinc, iron ore, gold, the full depth and breadth of the mining sector. And so building out our diversification. And if we start with iron ore, as we stand today, we've got iron ore, copper, gold, and lithium. Want to continue to broaden that is the objective.
And there's a specific question about the Mexican regulatory environment and political risk there, and this is connected to Sonora, I believe. You were mentioning about how most of these are in kind of very, Class A, very reliable jurisdictions, US, Australia, etc. So yeah, someone's just asked a little bit more about whether you see that as a particular risk and how Trident is approaching Mexico.
Yeah, so that one, there's a bit of nuance to that particular transaction. I'd point people to the RNS where we announced the deal, because it goes into sort of the weeds on how we structured that. But it is effectively a right to purchase, so we haven't acquired it yet. We sort of put down a deposit effectively and can recover that full deposit in certain scenarios. In other scenarios, if we choose to walk away, there's a small sort of break fee. But all in all, for a large, significant tier one asset, it's an incredibly cheap option for Trident. So the risk that question is sort of questioning was Mexico started making rumblings, given how hot the lithium market had gotten and the sort of projected demand for lithium, had started making rumblings about nationalization of assets. Now they've subsequently clarified that and sort of said, well, we're talking about newly issued licenses, and if a license has been issued and it's in good standing, which Sonora is, as we understand it, then there would not be a risk to that asset. So I think that language is sort of softened. But then obviously we want to be proactive in these sort of things. So then what we've done and what you would have seen in the most recent announcement about Sonora from us is we've extended our right to purchase up to January 2025, or 6 months after first royalty receipt. So that's an incredible option for us. In the scenario where this thing kicks off construction in earnest next year, and you can get to the point where it's the royalties actually being paid, and then you've got 6 months to consider where you want to buy half that royalty. that's an outstanding opportunity for us, and it allows us to see the project de-risked in a number of ways, through construction, through any sort of jurisdictional risk, all that, so we can sort of step back and as I mentioned, it's very sort of minimal potential break fee. You get to step back and watch that thing come into fruition, and depends on the ultimate size and scale of the project, but has the potential to have revenue profiles not hugely dissimilar from Thacker Pass. You can sort of take that gray bar and almost double it. And if we acquire the Sonora royalty and it comes in per expectations, it has the potential to be a very significant revenue generator for us. And I think some of the complexity around that particular asset, again, it gets sort of lost in the market. So when we're getting valued on just sort of revenue today, then you try to articulate that value in assets like the Rebecca Gold project or Thacker Pass. Then the Sonora one being sort of a right to purchase and long dated one at that. Although it's a great transaction, I think the value realization is hard for people to sort of wrap their minds around.
Absolutely. Well, thanks for I know last time you were here, I think we were still talking about the political risk potentially of Thacker Pass in Nevada. So yeah, it's good to hear particularly the good news on that one earlier in the presentation. So just to close out, a question's come through here about how Trident manages the operational performance.
Yeah, that's actually one area where, flip back to the portfolio slide here. That's one area where, I guess just where royalties have this scalability, the fact that there is 4 members of the management team, we're not actually operating these assets. So you want to get royalties over, assets that are operated by good, large mining companies that have strong balance sheets. But what we don't have is a cast of thousands of employees to actually manage these operations. That is the mine operator's job. So, Ganfeng, Lithium Americas, Equinox Gold, Victoria Gold, their job is to operate these assets. We've got royalties over the assets. We monitor their progress. We audit them from time to time. But effectively, it's a very scalable business from our perspective because you acquire the assets, you collect the quarterly revenue, but you're then focused on going out there and acquiring more assets and broadening out the portfolio. So we're not mine operators, is what it boils down to. And royalty companies love to shout about their revenue per head count relative to mining companies, because the fact is there's this huge dislocation where mining royalty companies, if we have circa 15 million potentially in revenue this year, then 4 employees relative to a mining company that revenue would be measured in the tens of thousands per employee if they're lucky. It's just a very different business model and very much built for scale in that regard.
Excellent. Adam, so good to hear from you again. And like I say, there's always some good, but good news, but well evidenced good news, which is, I think, what we like in particular at UK Investor Magazine. So thank you again for your presentation. And I'm sure there will be another update before long, either from you or I know there's quite a lot of coverage on the website as well about Trident, because I know it's something that a lot of readers are quite excited in. So thanks again, and hopefully we shall be hearing from you again before long.
Absolutely. Thank you.